August 9th, 1934. Executive Order 6-842.
Would be living at the point of a gun loaded with explosive bullets, economic being in such danger as now.
The government demanded Americans surrender their silver bullion to the United States Mint within 90 days. Same penalties as the gold confiscation the year before. 10 years in prison, a fine equivalent to $240,000 in today's money. And here's what most people don't realize. This actually happened, not to gold, to silver. Everyone talks about the 1933 gold confiscation, Executive Order 6102. But they miss the detail that matters most for anyone holding silver today. Because what happened to silver in 1934 reveals a pattern, a template. And the mechanisms that made it possible are being rebuilt right now, just in a completely different form. Let me be clear from the start.
It is definitely a part of our policy to increase the rise. If we cannot do this one way, we will do it another.
I'm not predicting that federal agents will show up at your door demanding your silver. That specific scenario is unlikely for reasons we'll explore. But what I'm going to show you is how confiscation works in the modern era, not through force, through something far more elegant, far more efficient, and far harder to resist. Most people who talk about precious metals confiscation get a critical detail wrong. The gold confiscation of 1933 and the silver confiscation of 1934 were two separate operations with different mechanisms. Executive Order 6102, signed by President Roosevelt on April 5, 1933, targeted gold. The government needed to remove the constraint on money printing.
Official pronouncements, America would be next to devalue its currency. International investors rushed to redeem their dollars for gold.
The Federal Reserve couldn't expand the money supply because they didn't have enough gold to back it. By forcing citizens to exchange their gold for paper at $20.67 per ounce, then immediately raising the official gold price to $35 per ounce, the government effectively devalued the paper they gave citizens by nearly 70% overnight.
Our dollar is now altogether too much influence. The control of the gold value of our dollar.
But silver, that came next. And it worked differently. Executive Order 6814, signed in August 1934, required the delivery of silver bullion to the government. Unlike gold, circulating silver coins were exempt. The government wasn't trying to take silver out of everyday commerce. They wanted the bars, the stockpiles, the bullion. Why? The Silver Purchase Act of 1934 had a specific goal: increase silver to 25% of the combined value of gold and silver reserves. They needed raw material to mint more coins and back the currency. Approximately 113 million ounces of silver were surrendered under that order. The government paid 50 cents per ounce, slightly above market rates at the time. If you made a profit on that silver, you got hit with a 50% windfall tax. The entire operation was designed to funnel hard assets from private hands into government vaults, compensate citizens with paper promises, and then adjust the rules so those paper promises bought less than they did before. Sound familiar? How enforcement actually worked. Here's what they don't tell you in the history books.
For the rest of the world, the financial repercussions were staggering.
Enforcement was almost entirely dependent on voluntary compliance. The federal government didn't have the manpower to go door to door. They didn't have the resources to search every safe deposit box, every buried jar in the backyard. The Treasury Department compiled a list titled Hoarders of Silver before the order went into effect. It identified the largest commercial silver traders and major bullion holders. If you owned less than 50,000 ounces, you weren't on that list. The government knew it couldn't chase down every small holder, so they focused on the big fish. This was efficient confiscation. Within the 90-day deadline, approximately 109 million ounces of silver flowed into the Treasury. Another 4 million trickled in before the order was eventually rescinded in 1938.
Tens of thousands of tons of confiscated silver in storage. This certificate is redeemable for silver on demand.
But here's the detail that matters most for understanding the present. The Silver Purchase Act of 1934 included a 50% windfall profit tax on silver sales. This wasn't just confiscation. It was tax policy designed to make holding silver financially painful. You couldn't use your silver freely. You couldn't sell it at market rates without giving half the profit to the government. Your wealth was effectively frozen. This is the template that financial historians point to when they discuss modern wealth controls. Physical confiscation is messy, unpopular, and difficult to enforce. Taxation is clean, legal, and almost impossible to evade if the financial system is properly structured. Let's be fair and examine why a 1930s-style confiscation is much less likely today. First, gold and silver are no longer part of the monetary system. The government doesn't need your metal to back the currency because the currency isn't backed by metal. They can create unlimited dollars digitally whenever they choose. Second, the political backlash would be enormous. We live in a different era with different communication tools. A confiscation order would go viral within minutes and create massive resistance. Third, the logistics are exponentially more complex. In 1933, precious metals ownership was concentrated. Most Americans didn't have significant holdings. The gold that mattered was in bank vaults and formal financial channels. Today, precious metals ownership is dispersed among millions of individual holders. There are dozens of major online dealers, countless local coin shops, person-to-person transactions that leave no paper trail, international storage options. The infrastructure for tracking and seizing is enormously more complex. Fourth, constitutional resistance. Any confiscation attempt would face immediate legal challenges. The current Supreme Court has shown willingness to limit executive overreach. Fifth, and perhaps most importantly, enforcement. During the 1930s confiscation, compliance was estimated at roughly 60 to 70%. That means a third to 40% of Americans simply ignored the order and faced no consequences. Today, trust in government institutions is at historic lows. Any confiscation order would be met with mass non-compliance from day one. So what's the realistic scenario? The modern threat, digital encirclement. The next confiscation won't look like federal agents knocking on your door. The infrastructure being constructed today is far more elegant. In July 2023, the Federal Reserve launched FedNow, an instant payment system that allows banks and credit unions to transfer funds in real time, 24 hours a day, 7 days a week. Let me be precise here. FedNow is not a central bank digital currency, but it's the kind of infrastructure that could support a CBDC if one were ever created.
The Federal Reserve is developing the FedNow service, a safe and efficient instant payments infrastructure.
As of 2025, 137 countries and currency unions representing 98% of global GDP are actively exploring central bank digital currencies. There are currently 49 CBDC pilot programs running around the world. China is the furthest along among major economies. They've created over 2.25 billion digital wallets for their ECNY. In January 2025, an executive order was issued prohibiting federal agencies from undertaking any action to establish, issue, or promote a CBDC in the United States. This effectively paused any movement toward a retail digital dollar. But here's what I want you to understand. The technological capability exists. The infrastructure is being built globally, and policy positions can change with new administrations. The question isn't whether a CBDC is coming tomorrow. The question is, what happens to physical precious metals if and when any form of programmable money becomes dominant? Let me paint a picture. This is a thought exercise based on historical patterns and technological capabilities. Imagine a scenario where some future administration decides that to combat tax evasion or financial crimes, all transactions above a certain threshold must be conducted through authorized digital channels. This wouldn't be unprecedented. Many countries already have limits on cash transactions. In such a scenario, your silver doesn't get confiscated. Nobody shows up at your door. But when you try to sell that silver to pay your property taxes or buy a car, you discover that the buyer can only pay you through a system that reports the transaction automatically. Maybe that transaction triggers a notification. Maybe it requires additional documentation. Maybe there's a special tax applied to precious metal sales that didn't exist before. Your silver is still yours, but its utility as a wealth preservation tool has been significantly diminished. This is what I call digital encirclement. You don't ban the thing. You don't confiscate the thing. You just make it progressively harder to use the thing in the normal economy. Remember the 50% windfall tax on silver profits in 1934? That wasn't confiscation. That was making it economically irrational to hold and sell silver. You got to keep your metal. You just couldn't benefit from it properly. Some financial observers have speculated about scenarios where precious metals could be subjected to special windfall or wealth taxes during times of fiscal crisis. An 80% tax on capital gains from precious metals would make selling extremely painful, essentially trapping your wealth in a form the government would prefer you didn't hold. Your silver isn't confiscated, it's taxed into irrelevance. The fiscal reality driving everything. As of December 2025, the United States national debt stands at approximately $38.4 trillion. That's $112,000 for every single person in America. It's growing at a rate of roughly $6.1 billion per day. Just 5 years ago in 2020, the debt was $27 trillion. We've added $11 trillion in half a decade.
Well, we do think that the US dollar is going to be under downward pressure through the course of calendar year 2020, so I think there are a number of factors.
But here's what really matters: the interest payments. In fiscal year 2025, the United States paid approximately $981 billion in net interest on the national debt. That's nearly $1 trillion just to service existing debt. 5 years ago, that number was $345 billion. We're now paying almost 3 times as much in interest as we were paying during the COVID pandemic year. Interest payments now exceed what we spend on Medicare. They exceed what we spend on national defense. This is not sustainable. Everyone knows this. The math doesn't work. So what does this have to do with silver? Everything. The government needs flexibility to manage this debt situation. They need to be able to print money, adjust interest rates, and control capital flows without obstruction. Physical precious metals represent an alternative. They're wealth that exists outside the banking system. Wealth that can't be inflated away. wealth that can't be easily tracked, taxed, or controlled. Why silver is different from gold? Silver holders are in a unique position within all of this. Gold gets all the attention. When people talk about precious metals confiscation, they almost always mean gold. But silver has characteristics that make it fundamentally different. First, silver is an industrial metal. More than half of global silver demand comes from industrial applications, not investment. Solar panels alone now consume approximately 17% of total silver demand, up from less than 6% in 2015. Consumer, electronics, medical devices, water purification, 5G networks, electric vehicles, all of these require silver. A government attempting to restrict silver would simultaneously be restricting industrial supply chains. That creates powerful corporate lobbying against any such measures. Second, silver is affordable. At current prices around $66 to $60 per ounce, silver remains accessible to average retail investors. A single ounce of gold costs well over $4,000. This means silver ownership is far more dispersed among ordinary citizens. Confiscating silver would affect far more voters than confiscating gold. Third, silver has a dual nature. It functions as both an industrial commodity and a monetary metal. This ambiguity provides some protection. Is your silver bullion an investment or an industrial raw material you're holding for a future project? The line is blurry, which makes regulation more difficult. Fourth, silver's physical characteristics favor the holder. Silver is bulkier than gold by value. $1 million worth of gold fits in a shoebox. $1 million worth of silver requires significantly more space. This makes silver harder to concentrate and easier to distribute among multiple locations. The supply crisis. Nobody's talking about silver has been in a structural supply deficit since 2021. That means global demand has exceeded global supply for 5 consecutive years. The cumulative shortfall from 2021 through 2025 totals almost 800 million ounces. That's equivalent to roughly 10 months of global mine production that simply doesn't exist anymore. Global silver mine production reached approximately 820 million ounces in 2024, but demand continues to outpace this supply. The electrical and electronic sector has increased silver consumption by 51% since 2016. This isn't speculation. This is fundamental supply-demand economics. Silver prices reflect this reality. After spending most of 2024 consolidating between $28 and $34 per ounce, silver broke out in 2025. At various points this year, silver has traded well above $60 per ounce, reaching new multi-decade highs. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged between 51:1 and 61:1.
Silver, well. Here we are at 84, around 85. We've had another leg up. Gold has done what looks like a breakout. What you have to think about is that this is all about gold.
At various points in recent years, this ratio has exceeded 81:1 or even 91:1, suggesting silver remains historically undervalued relative to gold. When precious metals enter bull markets, silver historically moves faster and further than gold. The smaller market size amplifies price movements. Here's something significant. Russia became the first central bank in modern history to explicitly accumulate silver reserves with a reported $535 million purchasing program. When governments start accumulating silver, it signals something about their view of its future monetary value. Let me add some context about the supply side. Silver mining is often a byproduct of other mining operations. Roughly 70% of silver production comes from mines primarily focused on gold, copper, lead, and zinc. This means silver supply can't easily respond to price increases. If silver doubles, mine operators can't simply double production because silver isn't their primary focus. New mine development takes 10 to 15 years from discovery to production. Even if silver prices encourage massive new exploration today, meaningful new supply wouldn't reach the market until the mid-2030s or later. Meanwhile, demand keeps growing. The photovoltaic industry alone is projected to consume increasing amounts of silver as solar installation continues to expand globally. China increased its solar capacity by 45% in 2024 alone. There's also the above-ground inventory question. Unlike gold, where almost all gold ever mined still exists in some form, silver gets consumed. Industrial applications destroy silver at a molecular level. It disperses into electronics, medical equipment, and industrial processes, becoming economically unrecoverable. The Silver Institute estimates that since 2019, more than 1.1 billion ounces have been drawn from available mobile inventory.
Silver, a lot more volatility, which to me, I believe support is now 70. I don't think we're going down to 50 at all.
That's silver that was accessible and has now either been consumed or locked into investment products like ETFs, where it's held but not available for industrial use. This creates what some describe as a slow-motion supply crisis. Not a dramatic shortage that makes headlines, but a persistent tightening that supports prices over time. What this means for silver holders. If you own silver or are considering ownership, here's what you need to understand. Physical silver is not a get-rich-quick scheme. It's not a trading vehicle. It's a form of wealth preservation that exists outside the traditional financial system. Silver doesn't produce dividends. It doesn't generate interest. It doesn't grow earnings. What it does is maintain purchasing power over very long time horizons while remaining physically in your possession. Right now in the United States, owning physical silver is completely legal. There are no restrictions on how much you can buy, hold, or sell. When you sell silver, you're required to pay capital gains taxes on any profit. Collectibles like precious metals are taxed at a maximum rate of 28% for long-term gains. This is higher than the rate for most investments, but it's the current legal reality. Consider geographic diversification. The advantage of the modern era is that you're not limited to domestic storage. International vaulting services in jurisdictions like Switzerland, Singapore, and the Cayman Islands offer legal options for storing precious metals outside your home country. This isn't about evading taxes or breaking laws. It's about reducing single-country risk. Consider form diversification. Government-issued coins like American Silver Eagles, Canadian Maple Leafs, and Austrian Philharmonics carry sovereign status. They're recognized worldwide, have guaranteed purity, and in some jurisdictions receive preferential tax treatment. Constitutional silver, pre-1965 U.S. coins with 90% silver content, carries an interesting historical footnote. These coins were explicitly exempted from the 1934 silver confiscation. While past exemptions don't guarantee future protection, some holders view junk silver as carrying historical precedent for regulatory leniency.
Okay, so the first thing I want to start out, and this is probably the most important thing, I want to talk to you about the math for 90% silver.
Understand that silver is a long-term strategy. Precious metals go through cycles. There will be periods where the price declines significantly. The point isn't to maximize short-term returns. The point is to maintain a portion of wealth in a form that cannot be debased by central bank policy, cannot be frozen by a bank, and doesn't depend on any institution keeping its promises. The pattern you need to recognize. Let me zoom out and give you some historical perspective on why this matters. Every paper currency in history has eventually failed. The Roman denarius started as nearly pure silver during the Roman Republic.
And one of the scholars that we referred to, it's the very first coin in his accounting of the coins of the Roman Republic.
By the time of the empire's collapse, it had been debased to less than 5% silver content. The French assignat of the 1790s hyperinflated into worthlessness. The Weimar German mark of the 1920s became so worthless that people burned stacks of bills for heat. The Zimbabwe dollar, the Venezuelan bolivar, the Argentine peso. The pattern repeats across centuries and continents. The US dollar has lost approximately 96% of its purchasing power since the Federal Reserve was established in 1913. What cost a dollar then costs roughly $30 now. Meanwhile, gold priced at $20.67 per ounce in 1913 now trades well above $4,000 per ounce in 2025. Silver priced around $0.60 per ounce in 1913 now trades around $66 to $67. This isn't coincidence.
Today it's the 1934 U.S. quarter. Let's take a look at that Philadelphia one. No mint mark there, and that's how you can tell the difference between the two of them.
It's the mathematical result of currency debasement versus monetary metals that cannot be printed. The current fiscal situation of the United States, with debt at $38 trillion and growing by $6 billion per day, with interest payments approaching $1 trillion annually, with no political consensus on reducing spending or increasing taxes, suggests that significant currency debasement is likely in the years ahead. In this environment, holding some portion of wealth in assets that exist outside the fiat currency system isn't crazy. It's prudent. The questions you need to ask: what percentage of your wealth exists in physical form that you directly control? Not a number in a bank account, not a stock certificate held by a broker, but actual tangible assets in your possession or stored under your direct instruction. If your bank account were frozen tomorrow, how would you pay your bills? This isn't a paranoid fantasy. Bank freezes happen regularly in countries experiencing financial crisis. They happened in Greece in 2015.
World markets are keeping an eye on the worsening financial crisis for fear that it may spread in Europe.
They happened in Cyprus in 2013. If the rules changed overnight,
The first and fundamental fact is that what started as a European war, as the Nazis always intended it should develop,
as they did in 1933 and 1934, are you positioned to adapt, or would you be caught completely unprepared? The Americans who were prepared in the 1930s, who had thought ahead, who had diversified, those were the ones who came through intact. The specific risk might be different today. The exact mechanism might be different, but the principle remains. Systems that seem permanent can change rapidly when pressured. Rules that seem fixed can be rewritten when convenient. And wealth that exists only as numbers in someone else's computer is wealth that exists only at their pleasure. Physical silver sitting in your safe or secure vault under your name is not subject to someone else's permission. It doesn't require a network connection. It doesn't depend on a bank staying solvent. It doesn't care what the government's fiscal situation looks like. It's just metal, real, tangible metal that humans have valued for 5,000 years and will likely value for 5,000 more. The confiscation orders of 1933 and 1934 were responses to a specific crisis. That specific situation no longer exists. But the lesson of history isn't just about the specific mechanism, it's about the pattern. When governments face fiscal emergencies, they look for wealth to capture. In the 1930s, that meant seizing silver bullion. In modern times, it more likely means increasing taxes, expanding reporting requirements, restricting transaction methods, and using technology to close escape routes. The threat to silver holders isn't a knock on the door at midnight. It's the gradual construction of systems that make holding and using precious metals progressively more difficult. Will these things happen? Nobody knows. But the infrastructure for them is being built. The technology exists. The fiscal pressures are real, and the historical pattern of governments capturing private wealth during crisis is as old as government itself. Maybe that's worth thinking about. Maybe it's worth preparing for. Because understanding this history isn't just academic. It could be the difference between being prepared and being caught off guard. The goal isn't fear. The goal is preparation. The goal is understanding. The goal is being positioned intelligently for whatever comes. Because in the end, the people who do best in any financial environment are the ones who thought ahead, who considered possibilities, who didn't assume that today's rules would be tomorrow's rules.